Welcome to the part of the week that matters the most. If wealth matters, your wealth matters.
Yes.
I'm Warren, I'm a corporate banker in the City of London, and I'm here to make wealth building simple and accessible. Today we are talking about tax, the working man's kryptonite, specifically property tax. It's a topic that I've been asked questions on probably the most out of all of the things, either through Instagram. If you're not following me on Instagram, by the way, I post every other day and I'm accessible on there. Love talking to you guys. But I get asked it a lot, and it links into the question of whether you should buy a property as an individual or through a limited company. So today we're going to talk about that. Prior to the year 2017, there was what I would call a golden age for landlords, i.e. property investors. Why? Because mortgage interest, the interest that you pay on your mortgage, was 100% deductible when it comes to paying tax. So for example, if you as a landlord had a property and you're receiving £10,000 per year in gross rent, and say your mortgage interest costs were £4,000 per year, you would only pay tax on the £6,000. So you pay less tax. And then from 2017 until 2020, the government introduced new laws that basically phased out your ability to deduct mortgage interest from your gross rent for tax calculation purposes. So in that example we just used, you'll pay full tax on the £10,000 worth of gross rent. So you would essentially pay more tax. What happened off the back of that, just for some knowledge for you guys? A lot of landlords said, okay, that's it. I've had a good run, a great run when it comes to making profits from property. I'm out now. I'm gonna have to pay more tax. It's not really cost effective to do this landlord thing anymore. And a lot of them sold up. Now, if you watch any of my other videos, you'll know me. I love taking opportunities in the midst of crisis. That's the best time to make money.
Message.
Whether it's property, stocks and shares, crypto, whatever it is, but we're talking about property. So many landlords, I think, panicked and exited the buy-to-let market way too soon. And that was a time when people like me were coming into buy-to-let. And a lot of you may ask, well, Warren, why would you enter the buy-to-let market as laws are actually changing to penalize, seemingly penalize landlords more? However, guys, this is the purpose of this video. I myself invest through a limited company because it's a legal way for me to pay a lot less tax as opposed to me investing as an individual. And I'm going to explain this more as we go further on in this video. So guys, right now, today, there are two main ways that you can invest in property as an individual or via a limited company. Let's talk about investing as an individual first. If you're investing as an individual, you're going to pay tax on your rental income via your income tax. Now, what is your income tax? Well, as the name suggests, not a trick question, income tax is tax on your income. So a lot of you have employees, you work for companies, they actually calculate your income tax for you and they send that submission, it's called your self-assessment, off to HMRC at the end of each year, around about April time, and that calculates the tax that you pay on your income. It's all done in the background, and your employer actually deducts this from your wages each month. It's why when you look at your payslip, your gross pay is up here and your net pay is down there, because your income tax, your PAYE, and other taxes, student loans, if you have any, are deducted at source by your employer and they pay HMRC for you. Now let's bring property income into the mix. So as an individual, your gross rental income is added to your salaried income and you're taxed as a whole on that total amount. So I'm going to put the current tax rates up on the screen right now. And as you can see, the basic rate is £12,571 to £50,270. At that rate, you get taxed 20%. So let's say, for example, your work salary was £50,269. So if you was just paid that salary alone, you'll get taxed at 20%. Now let's say you're a landlord earning that and per year you get £10,000 gross rent. So your total income is £60,269. Now that's going to bring you up into the higher rate tax band, and you're now going to be taxed 40% on your rental income specifically, because that portion of your rental income has brought you into the higher tax band. So tip number one, guys, whenever you're thinking about property taxes, remember to add your rental income to your salary income and calculate the amount as a whole, because that's how HMRC calculate your taxes. If your salary plus your property rental income keeps you within the 20% tax band, i.e. under £50,271, Generally speaking, you're better off buying as an individual rather than via a limited company. As a general rule of thumb, you want to consider buying in a limited company if you're in the 40% and above tax band. So now let's move on and talk about investing via a limited company and the corporation tax. This time, when you buy via a limited company, you're not going to be charged income tax from that amount. You're going to be charged corporation tax, because legally speaking, your properties are going to be owned by a legal entity as opposed to yourself. And the tax on legal entities is different from income tax on individuals. Right now, at this moment in time, the corporation tax rate is 19%. If you're watching this in the future, check on the government website because it may well have changed. But let's define what corporation tax is. Corporation tax is a tax on businesses calculated on your profits. That's very important, guys. It's calculated on your profits, not your gross income or your gross revenue, as the equivalent would be for a business. And the reason why this is really important, the distinction between profits versus gross income / gross revenue, is that when it comes to profits, you're able to deduct operating costs. So me, myself, I invest via a limited company. I am able to deduct from my gross rent, my mortgage interest, my service charge, my ground rent, the costs of repairs, council tax, when I don't have any tenants in and I have to pay it. I'm able to deduct agent fees, all of those I get to deduct. So the amount left is a lot smaller that I pay tax on versus if I was to do it as an individual. Not only am I not allowed to deduct interest, my mortgage interest from the taxable amount, but I'm not able to deduct certain operational costs as well. So the tax that I would pay as an individual is much higher than what I do pay as a limited company property investor. And right now I'm going to put up an Insta post a while back that I made, which really describes the differences. I've given 3 scenarios here. One where you're an individual paying the higher rate, 40% tax. One where you're paying the basic rate, 20% tax. And one where you're a limited company paying corporation tax on your profits. And as you can see from this example, guys, if you're a higher rate taxpayer, it's more cost effective 9 times out of 10 to buy property via a limited company as opposed to doing it in your own name as an individual. If you're a basic rate taxpayer, i.e. 20%, generally speaking, it's more cost effective to do it as an individual if you're a basic rate taxpayer. So guys, this was a real summary of the differences between tax, property tax, when you're holding property as an individual versus a limited company. Quick recap, generally speaking, it is more tax efficient. You pay less tax legally, when you hold property as a limited company compared to an individual if you're a higher rate taxpayer. If you're a basic rate taxpayer, generally speaking, it's better to hold it in your own name. One other tip for you guys, if you are a basic rate taxpayer and you bought a property, you're investing in property, you've done it in your own name, think towards the future. So do you plan on owning more than 1, more than 2? Do you plan on owning 5, 10 buy-to-let properties? Do you want to build a portfolio like I do? So you might be a basic rate taxpayer right now, but the more properties that you own over time, your income is going to go up. That's a good thing. We do this to get income, to make as much money from these as possible. However, what you want to be thinking of as well is that that increase in income is going to push you into a higher tax bracket. So if you have plans to build this big portfolio, you might actually want to invest via a limited company from day one. If you know you're going to build a portfolio of properties, and you might be a basic rate taxpayer now, but think towards the future and have that. Thank you for watching to the end. Guys, I've put together a property dashboard tool. If you're looking to buy a property in a short or medium term, this dashboard is going to calculate all of the key metrics and figures that you need to know when you're buying a property. It's going to automatically calculate things like your stamp duty costs, your returns, your profits, the future rise in value of your house, and if you're overpaying for that property relative to the UK average, as well as many other useful metrics and figures. The link is in the description below. And now back to the video. So I hope that was useful, guys. If you found this video helpful, share it with a friend. Drop a like, drop a comment. It really helps with the algorithm, helps this channel to continue to grow. You guys have been amazing. Follow me on Instagram and I'll see you guys soon.